the people coming in. Okay. Good morning, good afternoon, and good evening for all of you from around the world who are joining us. I see on our registration list we have people from Singapore, from Indonesia, from different countries across Africa to South America, a number of countries across Europe. Thank you very much for attending this taster lecture from our program director of our recently launched MSc in Financial Management. My name is Chris Ely, and I'm responsible for, and I see we've got someone from Hong Kong. Good day to you as well. So my name is Chris Ely, and I'm responsible for recruitment on our MSc in Financial Management. We have one of the largest MSc portfolios in the UK, with around 1,000 students joining our MScs every year. And we've also been pioneers in transnational education, where we've been offering master's level programs in Singapore and Hong Kong, as well as the UK since 1992. I see we've got someone from Tokyo as well, which is great. Welcome. And a few years ago, we as a business school decided to combine the success of our established master's programs and alongside the success or the successes of our transnational education programs. So the first stage of this has been to launch a blended learning MSc in financial management. It's been hugely successful, with over 100 students joining the MSc each year. One of the reasons I think for this is because the MSc has been designed in collaboration with industry. Many of our full-time MSc finance students will go on to do a PhD and go into a career in academia. Of course, this can be achieved with our blended learning MSc in financial management as well. However, that is not our number one goal with this financial management MSc program. Our number one goal is for our students to gain a deeper financial understanding and to go into industry. Into financial roles across a range of different industries, from automotive to FMCG, etc., etc. But also to go into the finance industry itself across a variety of different roles. So with that in mind, we wanted to bring to you something very topical that we are all seeing developing and evolving around us, and to give you a taster of what can be expected on our MSc in financial management that is delivered through our very established blended learning model. So without further ado, I'm going to momentarily pass over to Dr. Amedeo De Cesari, who is the program director for this program. There will be an opportunity for questions at the end of this webinar, so it's going to be about 30-40 minutes. So please put any questions into the Q&A, and I will also stay online after the taster lecture to answer any questions maybe about the program itself. But in the meantime, Amedeo, I'm going to hand over to you, and I'm sure you will all really enjoy listening to Amedeo for the next 30 minutes or so.
Thanks a lot, Chris, for your nice introduction. So I would like to introduce myself very briefly. My name is Amedeo De Cesari. I'm the program director of this MSc in Financial Management, and of course I teach within the program. I teach in particular corporate finance, and of course as a regular academic I do research and teaching, and I actually do research in several topics in corporate finance, and one of them is actually mergers and acquisitions. So I have several papers in this area, and I decided to pick this topic today because I thought it was very topical, somehow very interesting at the moment. It's one of the most important events, arguably, in the life of a company. So admittedly, in these 30 minutes, I will cover a few angles of this topic, trying to show you how we would teach a topic like this, and what kind of information we provide to students, what kind of challenges also we would pose to students. But of course, it's a very complex topic. And I have here the title of today's talk, which is Merger and Acquisitions. What are their drivers, and do they create value for society? That's a very ambitious question to address. So in the end, we're going to discuss a little bit this question. But throughout my talk, by the way, I'm going to use the terms takeover, merge and acquisition kind of interchangeably. So just to keep things simple. So I would like to start by providing an overview of today's talk. So again, I'm going to explain a little bit the purpose of what we are doing here and why I structure this small lecture the way I did. So the purpose again is to showcase how we would teach a topic as topical as this one in our program, and what kind of information we will use. Secondly, I want to introduce a very important principle in finance, which is the principle of fair value maximization. Today, we're going to discuss this principle in the context of merger and acquisitions. And of course, we are all eager to understand what is happening on a daily basis, or perhaps even more frequently to Twitter, whether or not the company in the end will be taken over, and when that will happen and under what conditions. So it's a very exciting time to follow news about Twitter for that reason. Then I will go into some kind of more academic content, perhaps. So we're going to look at a typical timeline of a takeover. And again, I'm going to generalize quite heavily here. So definitely in different places, you may have different timelines, different regulations. I will keep this very general, very broad. And then we are going to discuss what may drive a company to take over another company, and also what may drive the acquired company to accept the bid from an acquirer. We're going to discuss then some evidence on market reactions. So how does the market see a takeover bid? Is the reaction positive or negative? Who benefits basically on the stock market? And finally, I'm going to look at this topic, very hot topic among academics, but also for politicians and regulators. And I'm using here this kind of suggestive term, killer acquisitions. Okay, so basically acquisitions somehow that are aimed at essentially taking over a competitor. Okay, we're going to discuss this at the end. Let's start from the purposes of this time today together. Of course, we want to learn something new together, but I also want to show you how indeed the learning process would happen within our MSc in Financial Management. So first of all, in our MSc, we're going to focus on very important topics, very important financial topics. So we're not going to look at issues that perhaps are relevant, but not particularly relevant when it comes to the management of a company. We're going to focus on the key events, the key decisions that would affect in the long term the value of a company. So arguably, the takeover of another company is a very important strategic decision that is going to affect the value of the acquirer to a large extent over the long term. So indeed, this is the type of topic we are going to focus on in our MSc in Financial Management. And the way we ask students to study this topic or similar topics can be again showcased today by looking at some of the information I'm going to provide later. In a nutshell, though, as Chris was explaining at the start, this program is aimed for people that want to work later on in industry, they want to work in a company, they want to work in a financial institution. So there is a focus on practical application. There is a focus on data, on information from current events, on how we can perhaps come up with a solution to a challenge that the firm can indeed face in practice. So perhaps how can we come up with an evaluation of a particular firm that would allow us then to decide whether or not we can take it over. This could be a very relevant question that we try to tackle in this MSc in Financial Management. So So we don't focus a lot on very complex theoretical constructs. Having said that, finance is based on some important theoretical principles. So we need to know those principles. We need to know some underlying principles that are important to financial managers, but then we apply them in practice, and that is the main purpose ultimately. One important point is that we often use case studies in our work, in our assessments also from real companies. So we ask our students basically to use data from real companies. Sometimes in my own unit, for instance, I ask students to apply a particular technique to their own company. So I say, given that you know your company very well, gather data on your company and try to explain perhaps how your company is behaving, and perhaps try to provide even advice to your company based on your analysis, based on some particular techniques that we teach in this program. So today, hopefully, you will know more about how we teach in this program. Now, one important principle we have to start from to understand also today's material is the principle of fair value maximization. So you probably know that perhaps we financial economists over time have been accused of just focusing on shareholders. So we often say that somehow companies ultimately in the long term should try to maximize their own value, and in particular should try to maximize the value of the investment of their shareholders. So the focus of a large part of our content is on this very important principle. So if we actually kind of translate this principle in the context of an M&A deal, the idea is that, okay, is this deal beneficial or not to the shareholders of the companies that are involved? Is the deal beneficial, for instance, to the shareholders of the acquiring company? Is the deal beneficial to the shareholders of the target company? So in this case, is the deal beneficial, for instance, to the shareholders of Twitter or not? Okay, so that's a very important starting point that we consider every time we try to understand a topic a bit better. Now, of course, that doesn't mean that we do not focus on other stakeholders. Okay, nowadays, in all of our subjects, in all our units, we actually also focus on the benefits and the cost for the wider society. So we do not focus just on shareholders, we also focus on, let's say, employees, the local community, the tax authorities, the environment, for instance, and so on. In the case of M&As, one concern is that a takeover may be beneficial to the shareholders or the parties that are involved, but perhaps the takeover does not benefit society for a variety of reasons. I mean, we're going to discuss this later. Perhaps the takeover is going to reduce competition in a particular industry. So if you have a reduction in competition, arguably that's to the benefit of the company that achieves this reduction in competition, but it's not to the benefit of society necessarily. Admittedly, although more and more studies look into this issue, coming up with a precise estimate of the impact of any transaction on society is very difficult. So that's why often we start from shareholders and then we try to understand more about the impact on society whenever possible. Now let's look at this graph that I created the other day. I mean, I have to say that this graph goes from November 2013 up to April of this year. So in this graph, basically, I do not include the last few weeks. I do not include essentially the last few weeks of the current month. So that's just to make sure that we are on the same page. So what is this graph? This graph is basically the price of the company Twitter Inc. And it goes from the date when the stock started trading on the stock market. That was November, basically 2013, the 7th of November 2013, down to April 2022. And as you can see, when it started trading the company, it started trading at a price around 45. I believe the opening price was around $45 on the morning when it started trading. And that was much higher than the original IPO price. In other words, Twitter went public for a price far lower than the price at which it started trading on day one. So overall, you could argue it was quite a successful IPO in the short term. As you can see, the price went up pretty quickly afterwards. But then after that, it went up and down. I mean, there was a time when it was actually worth the stock less than 20 even. So basically, this would have meant a rather large loss. Then again, around 2017, 2018, 2019, it went up in value. It went up in value quite substantially near the end of 2020. And then it collapsed again afterwards. Now, what happened recently? Well, recently, I would say, if we go back to this graph, I would say starting from the start, basically 2022, we observed an increase in the value of the stock. And particularly in April, the stock has gone up in value quite substantially. As you can see on this graph, there are several days over which there is kind of a jump in the value of the stock. And of course, the reason why the value of the stock jumped, at least to a certain extent, is because of the events around the merger and acquisition affecting this company. So remember, this stock is owned by the shareholders of Twitter. And if an M&A goes through, the shareholders of Twitter will get money and they will basically sell their stock. Okay, so arguably, the value of the stock of Twitter is dependent on the conditions of the takeover, the possible takeover, quite clearly, and also the price of the possible takeover. So what do we find? Well, we find that on the 4th of April, so the very start of April, we have this jump in the value of Twitter stock. I think this was the time when Elon Musk essentially disclosed that he had built a large shareholding in the company. He had become the largest shareholder. And in the United States, it's my understanding that they also need to disclose, people that disclose their holdings, they need to also disclose the reasons why they're building the holding, whether or not they want to take over the company, for instance. So at this time, actually, it was not that clear, but I think Elon Musk did not say explicitly that he wanted to take over the company. But somehow investors were quite positive about this event. As you can see, there was an increase in the value of Twitter, quite substantial increase. So perhaps investors already were pricing a possible takeover. Remember, takeovers happen at a price that is normally much higher than the current value of the stock that is acquired. So inevitably, takeovers are good for the shareholders of the company as being acquired because they can get a high price for their stock. What else? Then, around the mid part of April, there was the bid by Musk. So Musk basically offers 54.2, and per share, this was what we call a hostile bid. So what this means is that essentially there was a negotiation with the board, with the managers of Twitter. Okay, so Musk just simply said, I want to buy your stock, you shareholders of Twitter, and I'm going to offer this. And please let me know whether or not you want to accept my offer. So 54.20 was substantially higher than the price at the time. And as you can see, there was a reaction from the market. So the market again was quite positive. Now the price did not go up to 54 because the market again thought, well, there is still some uncertainty. We're not sure whether or not the deal will go through. So that's quite an important point. Finally, the deal was agreed near the end of April. But even though it was agreed that there was a change in the value of the stock upward, again, the value of the stock did not go up to 54.20 to the price of the offer. The reason being that, again, there is still uncertainty. Okay, we know now there is quite a lot of uncertainty. We don't know whether or not the deal will go through. And we're going to discuss later why this uncertainty is there, and it is often there. Right? So nowadays, of course, there is a kind of battle of words, I would say, at this stage, and possibly there could be a legal battle because perhaps Twitter may like the deal to go through, irrespective of what kind of new information arises about the company. Whereas at the same time, the bidder essentially may try to withdraw from the deal. So that is why now the price of the stock is around 37, I believe, 36, 37. So there has been a decline in the value of the stock recently because of this new information arising on the deal. What about trading volume? Okay, this is the same period, the very long period between November 2013 and April of 2022. As you can see, there has been a big spike in trading volume in April 2022. So quite clearly, as you would expect, when news arises about a particular company, and this news have very significant value implications, you expect more people to trade the stock of that company. Okay, because essentially, if there are no news, what is the purpose of trading? Well, we could trade because perhaps we have some savings, we want to invest, or perhaps we want to sell some stock to make some other purchases. But generally, trading happens when there are news. Okay, news basically bring trades, especially when people have different opinions as to the implications of those news. And I guess in the case of an M&A, definitely people may have different ideas as to what the M&A implies and whether or not it will go through in the end. Now, in terms of a timeline or typical takeover, again, here I'm trying to generalize pretty substantially. I mean, takeovers can happen in different ways, in different places, different markets, depending on the regulations in those markets. But definitely, there is, first of all, a stage where when both the acquiring company and the target company, they think about the possibility of a takeover. So essentially, takeovers are part of a long-term strategy of a company trying to acquire other companies. So this initiation stage could be a long period of time over which managers say, well, we want to buy other companies, perhaps we want to enter into industries, new industries, perhaps we want to consolidate our position in a particular industry and we want to buy competitors. Likewise, even the targets of a possible takeover may think about being taken over. Okay, may think about, well, perhaps if we are very successful as a company, somebody will take us over, and the shareholders may be happy about that, and even the managers. Of course, the moment this idea about doing a takeover is somehow more concrete, at that point, we may have to select a specific target. So the managers may have to basically think about specific targets they can actually try to take over, or even the targets may think about possible acquirers they may want to get in touch with. So this target selection phase is very delicate because basically it's a phase in which we need to think about, the benefits and costs of acquiring a possible target, and also the cost of doing so, and also the price that we are likely to have to pay to buy a particular target. And of course, if the target is a private target in particular, so basically if we are dealing with companies that are not listed, often negotiations around M&As can go on for a long time without any communication to the market, because basically if they're private companies, they do not need necessarily to communicate to anybody. Those negotiations are going on. On the other hand, if the companies involved are public, especially if the target is public, then perhaps information about these negotiations may actually have to arise, may actually have to be made public if there is an offer, for instance. But anyway, if the companies involved in the deal are somehow friendly, in other words, both of them may want to come up in the end with a deal, then these negotiations could go on for some time. People could negotiate on the price. Companies could actually exchange information to understand better what the value of the target is. So this is basically the phase where when also the valuation can be of the target company can be kind of made. Of course, the acquirer will have advisors, will have financial advisors that will be able to evaluate the target company. And of course, this valuation will change depending on the information that the target company provides to the acquirer. One important point to make is that the payment method can affect also the reaction from the stock market, okay, when a deal is disclosed. So there are two main ways of paying for an acquisition. One is cash, this is the most obvious way, and one is the stock of the acquiring company. Okay, so the reaction from the stock market to the announcement of a deal may be less positive if stock is used. Okay, if the acquirer basically wants to use stock, perhaps the reason why the reaction is more negative is because somehow there is a sensation, there is a feeling that perhaps the acquirer is using overvalued stock to buy the target. Financing is also another important point. So of course the acquirer has to decide how to finance the acquisition, has to plan ahead whether to use equity, existing equity, or newly issued equity, whether to perhaps raise some debt financing. Now, at a certain point, of course, there is an announcement. So in the case of Twitter, we had basically two announcements. The first announcement was the bid, and that's the main one we're interested in as researchers. So the first time we hear about the bid. But the other one is also the announcement of the agreement, which is also quite important. Okay. However, even when an agreement has been reached, we do not have closure yet. Why? Well, because something can happen such that the transaction could be derailed, and somehow one of the two parties, particularly the acquirer, may actually try to withdraw from the deal, perhaps because new information arises. Okay, and of course, whether or not withdrawals are allowed, it's a legal issue, and it will depend on the contract that has been signed at the time of the agreement between the two parties. Now, a very important question is, do takeovers, do M&As create value? Okay, create value for whom? That's a very important point. So here we just look at mostly the shareholders, but also partly society. So there are reasons as to why we believe that M&As can create value, and also reasons as to why we believe that M&As could destroy value. So let's look at the positive side first, why an M&A can be beneficial. And again, we can actually think about this in the context of Twitter, for instance. We can do this using different deals and consider different deals we know well. So first of all, possibly there could be a creation of synergies, okay? So it is possible that somehow if we take the value of the two firms involved in the deal, the sum of these two values is smaller than the value of the new firm that is created by the deal. Okay, why? Because the moment we create a larger firm, we can exploit some synergies. For instance, we can make the new firm more efficient, we can exploit economies of scale, we can actually perhaps reduce some cost. Another reason that is less positive for society is the increase in market power. So we create a larger company that has more market power, and this company will be able to impose larger cost on consumers, higher prices on consumers. Okay, so basically the value creation for the shareholders may be there, but perhaps not for society. On the other hand, if there are synergies that create efficiencies, then perhaps they benefit both society and shareholders, because ultimately a more efficient company can actually sell products at a lower price, so it benefits everybody. One important point that could apply to many deals is the idea that a deal could be done to remove the current managers of the target company. Okay, that is why takeovers are quite beneficial in terms of discipline. The discipline managers, they remove potentially bad managers of targets. And because of that, the managers of targets, the managers of companies generally that could actually be taken over, they perhaps manage their companies better to avoid a takeover in the first place. On the other hand, there are many reasons why we can think, well, actually, takeovers are not a great idea even for the shareholders, not just for society. Okay. One possibility is that takeovers happen because of what we call empire building dynamics. So it is possible that managers, they want to take over another company to create a larger company. And the moment they manage a larger company, they can actually claim they should get a higher compensation. And I have a paper published in which we find this indeed. We find that after an M&A, there is an increase in the compensation for the manager of the acquiring company. So it's quite important we understand in this case, perhaps the M&A does not create value at all for the shareholders, just for the manager. There are also reasons why M&As happen because of some personal characteristics of the manager. So perhaps the manager is very confident, perhaps it's overconfident. So that's what we call the managerial hubris story. So in that case, I guess the manager may simply overestimate the benefits of an M&A. So the manager may be in good faith, but still the M&A is not beneficial to the shareholders and also to society. One other important point is that preventing takeovers, so allowing managers to prevent a takeover on their company, could also be negative for investors and also for society, because it would allow these managers essentially not to manage in the best possible way their company. Okay, so the disciplining effect of takeovers is very, very important. And if we eliminate them somehow, this can actually destroy value. So that's a very important point we need to remember. Now, what happens in practice? Okay, we have seen that in the case of Twitter, the market seems to like the deal overall. When we say the market, we mean the shareholders that own Twitter currently. They seem to like, on average, the deal. That's why the stock market price has increased. Does it happen often? Well, it does. I mean, there are many studies out there you can look into. I would say that generally the reaction is very large. It goes from 15 to 20%, in some cases even 25%. So on average, depending on which period we consider, which market, but it's very large. So definitely an M&A on average creates value for the shareholders of the target. Okay, why? Well, because they get a lot of money essentially for their own stock. They get basically a price at which they can sell their stock, which is much higher than the current value of the stock on the stock market. Okay, so they receive this large premium, and that's why inevitably they benefit. What about acquirers? Well, here the evidence is not that clear cut. So there is quite a lot of literature, but I would say that especially in the past, the evidence was that there was a negative reaction on average, although small, affecting the stock of the acquirers' shareholders. Nowadays, the evidence is more like for a small, but positive or very small market reaction. So we could say that it's around zero. We could say that the reaction is not particularly large. So it's not, perhaps it's not damaging, but it's not very beneficial either for the shareholders of the acquiring company on average. Now, what about society? Well, here is where I guess we find it much harder to provide an answer, but there is a concern among academics, practitioners, regulators, when it comes to what we call killer acquisition. This is a terminology, a term I borrow from a recent study that looks at this so-called killer acquisition. So essentially one concern people have is that nowadays there are some companies that dominate their own industry. More and more companies essentially dominate their own industries. And the reason why they do so is also because they essentially eliminate entrants as quickly as possible. So incumbent firms that are already there in one industry and somehow dominate that industry, they may try to take over very quickly new firms in order to eliminate competition. Okay, and arguably this is not going to be particularly beneficial. There could be some benefits, but also some rather serious cost. On the one hand, you can argue, well, this could be actually beneficial for, at the minimum, the shareholders of the incumbents, definitely. It could also be beneficial for the shareholders of the entrants, because if you think of it, if you know that this is going to happen, you can create a company, you can then enter into an industry and try to compete with one of the big companies in that industry. At a certain point, one of those companies will take you over and will pay a very high price to do so, and you as a shareholder will benefit. So potentially, these killer acquisitions are beneficial to the shareholders involved, but definitely they're not very beneficial to society. okay, because they reduce competition, they allow the large companies dominating the market to eliminate competition and to impose higher prices. There is even a darker side which has been highlighted recently. Some people even argue that this killer acquisition can even deter innovation, can even deter entry in the first place. And the argument is quite subtle, but the argument goes as follows. If you are in an industry in which customers want to use the services of a company over the long term, so they don't want to switch from one company to the other, then killer acquisitions essentially deter entry in that particular industry, because the customers in that particular industry are not going to invest and not going to, get products or services from an entrant. They know it's going to be taken over very quickly, okay? So the paradox is that these possible acquisitions do not actually entice new companies into an industry. They reduce competition, and they may actually reduce innovation and entry in the first case, which is quite a worrying outcome, of course. And I think with this, I have finished, more or less, hopefully on time. So, Chris, I think pass over to you again. I don't know if there are any specific questions, maybe I can address.
Thank you very much, Amedeo. Very interesting topic, and as I said at the start, but also very topical. It's going to be interesting to see what happens over the next few months, or well, it may well go into months, I guess, in terms of that Twitter acquisition. So to the audience, whilst we still have Amedeo here, you know, he's been speaking about mergers and acquisitions. Okay, we focused partly on Twitter, but are there any general questions that you would like to ask Amedeo, to ask his expertise on? Perhaps Amedeo, you could stop sharing the screen now, so we will have our images a bit larger. There we go.
I think there is already, I believe there is already a question. I believe it has been posted, so I'm not sure whether it's better if I read it first, or maybe I can just address this question.
Yeah.
I think I will just try to address it in general terms. So, yeah, this is a very difficult question to address in a sense, but I think we need to
sorry, Amedeo, just so the rest of the audience, because I'm not sure if they can see that. So the premise is, does the market on the whole or society actually lose anything or gain anything on this kind of M&A? Is the general point that Ryan is making.
Yeah, I think we need to be careful, because and that's where I guess we can get confused sometimes. You know, think about I don't know, Amazon. You know, you may think, okay, this company dominates a particular market. So arguably, based on some simple economic thinking, we may say, well, it's not a good thing because this company dominates the market, and this company could actually impose high prices on all of us customers, for instance. And we could have similar examples for other similar companies. But there is also the counter argument that somehow the company is very large, and being very large can actually benefit from economies of scale, from efficiencies. And for that reason, we can actually pay a lower price and perhaps get a better service. So per se, the fact that there is consolidation in one industry and perhaps two large companies in one industry merge is not necessarily negative for society. We cannot say that. Okay, it depends, I guess. It depends. So you could have, on the one hand, you could have basically efficiencies, economies of scale, which is beneficial. On the other hand, you could also have some costs for society if the company can impose larger prices, very high prices, basically on customers. So it's not that clear cut. I think the concern from some of the literature on killer acquisitions is the deterrence of possible killer acquisition when it comes to entry into the industry, because definitely we want markets to be contestable. We want basically markets to be places where other companies can enter basically and compete with existing companies. So the moment the market is not contestable anymore, then the dominant companies can basically do whatever they want, and that is the main concern, I guess.
Excellent. Any final questions before Amadeo departs? And then, as I said at the beginning of this webinar, I will hang around to ask any to answer any questions you may have on the program or the admissions requirements or our scholarship opportunities. Okay, so we've got Andrew Palmer here, who is asking, there was a private equity boom of inward investment into the UK over the pandemic. Has there been a slowdown in M&As since then? What effect might this have on economic growth recovery?
Okay, yeah, well, I haven't checked the data about the trend in M&As, frankly. Of course, there was a slowdown definitely during the COVID pandemic, but I haven't looked into the data honestly recently, whether or not there has been an increase in M&As, and also, frankly, we don't have so many data points. Now, when it comes to private equity, it's interesting because in the case of this particular Twitter deal, of course, the company is going to be taken private, which is not necessarily what always happens. So although in this case, perhaps the private equity issue is not that important, it's not that relevant, but in practice, there is evidence that if there is more private equity capital available, then of course, transactions like M&As that can take companies private become more frequent. Okay, so there is a kind of correlation. Financial markets normally go in waves, and often these waves are kind of correlated. So if we have a wave in private equity funding, we also have a wave in other transactions that are related to private equity investments. So again, I haven't looked at the data recently, but definitely normally there is a correlation between the two, between the private equity market and M&As, especially M&As that take companies private, basically, from being public.
Excellent. Thank you very much. Any final words from yourself, Amadeo, before I know you're going to be running into another webinar, so any final words from yourself? Yeah,
I mean, I just want to say very briefly that, again, hopefully this talk was interesting. As you can see from my talk, this is a complex world that we try to analyze. So if you enroll on this program, you're not going to get all the answers you want, but at least hopefully you have the instruments to investigate rather complex topics. And again, we try to make our program attractive to people that want perhaps to analyze their own company, the industry in which they work. So it is a program in which, on the one hand, we have some prescriptions when it comes to the content and assessments, but on the other hand, we also leave quite a lot of freedom somehow to students so that they can make the most of it. Okay, so hopefully I will see you later within the program, and if you have any questions, just get in touch. Okay.
Excellent. Thank you very much, and thank you and thanks for that talk. It was really fascinating.
Okay, thanks, Chris. Bye.
Bye. So I know, and to the audience, by all means, you can all now depart. But for any of you who do have any specific questions, by all means, feel free to ask me. Myself and my colleagues from our global campuses in Dubai, Hong Kong, Singapore and Shanghai will follow up with all attendees, and if you want to have a one-to-one Zoom consultation over the next week or two, we are of course more than happy to oblige. But in the meantime, by all means, ask me any questions on the program. And if you do want to ask any questions, you can type them in the Q&A box. If not, no problem. I will hang around for another couple of minutes just to see if we do have any additional questions. Sounds like no additional questions on the program. Well, I hope you really enjoyed that insight into the world of M&As and into the world of M&As that's currently happening, you know, literally this minute, this second. Definitely going to be interesting to see how that progresses over the next few weeks. So again, thank you very much for attending, and we will be in contact. And now the webinar will end.